Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 262 for May 4th, 2020. We are recording this live at 1 p.m. Eastern Time. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today we will be discussing the 345th weekly report. So if you haven't had a chance to take a look at that yet, just go to TimingResearch.com/reports, and you can access either the web or PDF version there. Today I have arranged for John Thomas and Jim Kenny to be here. Jim, the option professor, will be moderating. So I'm going to go ahead and turn it over to him.
Sure. Okay, thanks, David, and welcome everybody here. We've got another big week ahead. We've got a big unemployment report at the end of the week that everyone's talking about, and other information coming out. So it's going to be pretty interesting week as things come out. More earnings are coming out as well, so we'll have to see what's going to happen. Today, we're going to go over a lot of different information, and with us is John Thomas of the Med Hedge Fund Trader, and John is familiar to many of you, but for those of you who are unfamiliar, John, a little background on yourself and what's going on up at the company.
Well, I'm old as dirt and twice as dusty, been in the market for 52 years now. I run moderator.com. That is a global long-short macro trade alert service and mentoring service, which covers stocks, bonds, commodities, precious metals, energy, and real estate. And you can find us at moderator.com. And we are posting a profit so far this year with some volatility. So if you want to learn how to make money in crashing markets in a global pandemic, go to moderator.com.
All right, and at the end of the broadcast, you'll give more information on that and other offers you might have, so that's good. Starting out with some of the basic questions we do on Mondays is the S&P opened up today around 28.15, trading somewhere around there right now. Do you have any feeling for between now and Friday which way the wind will blow?
I would say, have you heard of sell in May and go away? I think I did that one before. This is a market that is wildly overbought, is twice as expensive as it was in January, and it's just begging for a correction. I'm looking for a correction down to, 2,500 in the S&P, maybe 2,400 on a bad day, which would roughly equate to about 50% give back of the move we had off the March 23rd bottom. The thing about this crash and the one we had in 08, things never got cheap in this crash. The Fed came in so fast, we never really got below a price earnings multiple on stocks of, say, 14 times. And in 08, the bottom was 9 times. So, and that may explain why Warren Buffett hasn't come in. They really never became bargains, except in the travel-related areas like airlines, cruise ships, hotels, and so on. And there you run the risk that they go to zero.
Right. That's, in other words, what they've been saying is a cheap price without having any idea of the valuation of what you're buying may not be a cheap price, right?
Yeah, don't confuse gone down a lot with cheap.
Right. The other thing, John, is that most stocks have not recaptured that 200-day moving average, and the ones that have are heavily dependent upon ad sales and business investment, meaning, Microsoft, Apple, Facebook, Amazon, Google. If it's not ad sales, it's definitely going to have to be business investment. And I noticed in the last report, business investment was down about 10.5%. And if we got cutbacks in either ad sales or business investment, these things that have been keeping the market higher because they're so big parts of the index, do you think they could have some pullbacks?
Absolutely. Every company in the country is now in survival mode. They're looking to cut costs wherever they can. Capital spending is the easiest thing to cut, especially if you think we're going to be in a recession or a depression for another year. So companies are cutting off staff, laying people off. eventually we could get to a U6 unemployment rate of 52 million, which is, by the way, the Fed's own forecast. And by the way, the current administration forecast is we go to 3,000 deaths a day in May. So these are not bullish things.
Yeah.
These are not chasing conditions. It's not like we're going to a new high every day. So unless you have absolute total conviction about a particular stock, cash is the better alternative right here.
Yeah, and Buffett obviously has a portfolio that's already being whacked, and so he doesn't need to be adding to something that he has no visibility on. So that's why they're hesitant to just go and even buy their own stock, simply because things that they own, obviously have come under a lot of pressure as well.
Well, and for Buffett to sell enormous positions, down 80% for probably the biggest loss in his career, really says something horrible about the U.S. economy for the next year. He says that the airlines have suddenly become uninvestable.
Right.
Uninvestable down 80%. That is a real, awful comment to have about the market for the next year.
Yeah, the one phrase that I heard somewhere was that there's no confidence in the spending patterns that could be altered by either the consumer or businesses as we come out of this. And if you have 30 million people unemployed, when you're getting your check from the unemployment office, that's not going to make you want to jump into a bunch of debt and a bunch of new investments, right?
Well, and also most states run out of money in the next week or two.
Yeah.
And 30 million was last week's number. We could easily tack on another 5 million this week. So the market has gotten totally detached from reality here. I see we've had a V-shaped recovery in the stock market, which I did predict, but a U-shape for the economy. And that disconnect isn't going to go on forever.
Yeah, the Fed seems to refuse to deleverage. In other words, obviously we have a leverage issue because 2 months of no cash flow should not destroy the entire thing. So obviously there's too much leverage. And just like when you're in a margin position, John, if you get a margin call, you got two choices, right? You need to add money or you need to reduce your leverage, reduce your positions. There seems to be such a religious fever against reducing your positions. Meaning, let the airlines write down these things, let the bondholders take a pinch, let the equity holders realize that they were buying on future earnings that aren't there. Let the system work rather than obscure the reality of price by dumping a bunch of printed money into the system to make people think that what's going on isn't going on. Do you see it that way at all?
I do. And our core trade right now isn't in the stock market, it's short the bond market. We're running a 40% short position in the TLT, which we started putting on at 175, and we got down to 166 this morning. And that's where we're making all of our money right now. These, every day 500 or 1,000 point openings in the stock market are essentially untradeable by anybody. Yeah. But with bonds, can you put the TLT chart up there, David? If you look at bonds, they hit essentially a 100-year peak and have been rolling over ever since. Okay, so let's go to like a 6-month chart on the TLT. Okay, there you go. We had this one super spike of 40 points. 44 points is a big move in the bond market.
Right.
Is just mind-boggling. And then we gave up the 40 in a couple of weeks, also even more mind-boggling, ran back up to the highs, failed, and that last spike up there looks like our last fail. So we could be setting up a head and shoulders top for the TLT and setting up a bear market, which could go on for 10 or 20 years. That's what happens when you launch 14 trillion worth of QE and fiscal stimulus in essentially 1 month, when the previous record of stimulus in the '08 crash was 800 billion. This is like 20 or 789 billion. This is like 20 times the previous level of stimulus. And if that isn't inflationary, if that isn't bad for bonds, then I don't know what a bond is.
Do you think this is an entire circle from 1982, meaning from the high to the low? You think it's a culmination of the move from 1982?
From 82 onwards is gone and dead.
Right.
And
You
you're
know,
basically looking to sell every rally for the next 10 or 20 years.
yeah, Buffett did make a point about defaulting on the U.S. debt, and he said that's not going to happen because obviously they issue the debt in their own currency, the U.S. dollar, and they can print dollars. The only risk, he says, is what are the value of those dollars at some point. And I
Yeah,
think that's what you're saying is these guys can continue to print money all they want, but
yeah.
you're not going to be able to possibly keep your currency up. Argentina, doesn't print in their own currency, and that's one of their big problems. So we don't have a problem on default. We just have a problem on what's the value of the currency going to be.
And by the way, we do have a president who's saying he's going to default.
Yeah.
You see that 4-point down spike
Yeah.
on Thursday. That was our most profitable day of the last 5 years. Thank you, Mr. President.
Yeah.
Running a 40% short, and the guy comes out and says he's going to default on the Treasury market. Yeah, we'll take more of that as long as we're short. What's your take on the bond market here?
No, my take on the bond market is that obviously they're going to be printing and printing and printing, but I see that they're cutting back. They were $75 billion a day in March, and now they're $8 billion a day this week. So either A, they realize they've gone too far with the printing and they got to cut this thing back, or B, they just see the balance sheet looking like, a drunken sailor's tab at a bar, and they gotta say we gotta slow this thing down because it's not necessary to get back to 3,700, by June, and that's the way they're printing as if they want to get it back to 3,700 by June, and they all want to get reelected. Let's face it. In 6 months, these guys could all be out of work. So they're not real concerned about the long term. They want to get this S&P above 2,800 and get the trend back up. And they definitely want to, get a V-shaped or some type of a V-shape before November, because they have absolutely no chance in their minds, I don't think, of winning unless they create this, even if it's an artificial rebound, just some kind of a rebound.
I think bubble is the word you're looking for. Also, those numbers you quoted, those are daily money market intervention figures.
Right.
And all down there is more a function of you don't have any more crisis financing going on among Fortune 500 corporations. And clearly, we've passed the crisis that took place in March. The numbers I'm looking at are the national debt, which goes from 24 trillion to 32 trillion by the end of next year. I mean, that's more than we spent on World War II and Vietnam combined. So that is what's really going to crush the long end of the market, the 10-year, 20-year part of the market. That's what the TLT focuses on. By the way, I think the stock market is such an important election indicator as it was. I think a far more important indicator is whether you're dead or not.
I watch fixed income very closely, and I can see mortgages are very firm, and I can see the money markets and short-term instruments are pretty darn firm. But there's two areas that are not firm, and that's why I think the Fed came out today and said the New York Fed is ready to start buying ETFs in the early part of May, because the high yield market and the muni market are still on very weak legs.
Yeah,
and
the stock market too. They announced they were going to buy it, and then they never bought anything. So now they may actually buy it.
Well, that was, to be honest with you, that's why everybody front run on them. In other words, the reason HYG came back is because they think the Fed's got the bid, and the reason munis were falling off a cliff and they came back a bit is because the Fed is supposed to be backstopping these people, so they're buying in the idea that they're not really buying junk, they're not really buying lousy munis, they're buying basically a Fed put. Now, they better come up with that put, because, Illinois, Houston, New York City, they're issuing bonds, and the yields on them are quite high because nobody's going through the Lincoln Tunnel, nobody's crossing the George Washington Bridge, nobody's going to Port Authority, etc.
And no one's paying taxes.
And they have no revenue from taxes coming in. That's what I'm trying to say is that there's a reason why, people that are in there like Buffett with large portfolios are not particularly interested in either buying their own BRK.B right this second, or jumping into a bunch of other things. I think it's a little bit curious how much money's being raised for distressed assets,
Okay, David, how about another stock?
Yeah, what do you want to see?
Okay, well, anyway, we're looking at the S&P, and your opinion between now and Friday was?
Down.
Down. And your percentage confidence on that is?
I would have to say 70, because, with the Fed intervening the way they are, anything can happen at any time.
Right. Because we're not really dealing with real prices. We're dealing with obscurity right now.
Notice that the government is timing its announcements of stimulus packages as every Wednesday night or Thursday morning, and that's to grab the headline from another horrific weekly jobless claims.
All right, let's throw up some of the bigger stocks in here. Let's bring up Amazon, AMZN, and let's see if John give an opinion on Amazon. It's up a little bit today, but what are you thinking here?
We have been bullish on this for a very long time. I ultimately see this becoming a $3 trillion company after they break it up, which probably would be in 5 years. Eventually, this company gets too big to manage. But for now, all trends created by the coronavirus epidemic was to accelerate all trends that were already in place. Well, all of those trends were, you go out of non-tech into tech, you go out of small into big, you go into bricks and mortar into digital, and everything piles right onto Amazon. Amazon takes advantage of all of that. So I wouldn't chase it up here, but if we get a second corona epidemic wave in the summer or fall, or we retest the March lows, then you want to go into Amazon big time, and you want to do things like 2-year leaps, 2-year call option positions on Amazon, where you can make 500 or 1,000% in 2 years. This will be one of a handful of lead stocks for the next 5 years.
200-day moving average is around 1857, and the former highs are around 2175. Are there some points down there that you would find more interesting than not on a correction?
I just don't even see it getting back to the 200-day moving average for the foreseeable future. This is a company whose problem is they're getting so much business, they can't fulfill it all. Workers are going on strike, deliveries are late, and they had to spend $4 or $5 billion in virus mitigation measures in their distribution factories. So these are all the kinds of problems you want to have. Your business is growing faster than you can handle it. And it already is one of the world's largest companies. I think it's like number 2 or 3 right now. So yeah, we love Amazon for the long term, but I would wait for a bigger pullback.
What do you think of the cloud revenue? We had a jump of 59% in Microsoft, but only 33% on AWS. Is that giving us a tip that that spending might be slowing down in that area?
Yeah, it's not. If anything, AWS business is exploding right now because everybody who had a cloud strategy before is now amplifying it. And those who didn't have cloud strategies are piling into it for the first time. I have friends at Salesforce, and everyone there is working an 18-hour day, 7 days a week right now, trying to accommodate a near doubling of overnight business. So, Amazon will post slower growth figures because they're working off a much larger base.
Right.
the Amazon cloud business is probably triple what Microsoft's is, but Microsoft is growing fast.
Yeah, somebody did tell me that with regards to cloud, that it does eliminate jobs, which saves companies tremendous amount of money. So there is economics to the cloud that are very, very strong, because when companies can reduce their overhead and reduce their liabilities for paying for insurance and all the rest of it, that's real value. And so the cloud does bring to the table real value, and that's why the long-term story of it makes so much sense.
David, can you put up Microsoft MSFT so we can look at that stock by comparison? Yeah, there you go. The other major player in the cloud business is Microsoft, and look at this. It looks like it wants to take a run at a new all-time high. And this is a stock where if it does roll over for any reason, let's say it gives up half the recent gains, so that would be 25 points, get down to 155. If Microsoft got back to 155, which looks like it's also the 200-day moving average,
right?
I would think I would have died and gone to heaven, because then stock, the call options, the leaps, any way I can get into this thing, I would do it, because they have a spectacular future. We've been recommending the stock ever since it was 50 when Steve Ballmer retired and they brought in Satoshi Nadella. So yeah, just buy every dip, and actually held up pretty well also in the crash. You know, it went from 190 to 130 and change, and then just bounced back immediately.
Let's talk about the two that are more reliant on ad sales. Can we put up Google and Facebook and take a look?
Yeah, sure.
Okay, there you got Google, and God, it looks like it just came back into the average there, and it'll be interesting to see if it can get through that neighborhood. If not, it could be interesting on the downside, huh?
Well, this is the problem with Alphabet. Demand for their services has doubled, while advertising has dropped by half. So costs up, profits down, not good for the short term.
Right.
However, that traffic over time eventually converts into more business. So, you know, obviously they're getting hit by the depression, but you know, if we go back and challenge those lows again, this is another company with another spectacular future. So I'd be buying Alphabet and Facebook is the other one you're referring to,
Right.
on major dips.
Yeah, Facebook technically on the moving averages is interesting because their moving averages are still inverted. 50 days at 170 and the 200 days at 190. So this was kind of an out of the blue rally that it had here on
Well,
pretty good size volume. Yeah.
They announced healthy earnings when everyone was expecting a disaster.
Right. Gilead Sciences, that might be confusing people because supposedly they came up with this, what do they call that, breakneck speed or speed of light or something? I never understood this, John. Didn't you hear that it was a flop from the Financial Times about a week ago? And then last week, the CDC said it was the best thing since sliced bread. I mean,
well, it's actually much worse than that. A year ago, it flopped. They then secretly continued research on it and then announced it succeeded. And then it turned out to be a potential corona treatment. You know, it's not a vaccine. It'll increase your survival rate if you actually catch the virus, but just barely. So, you know, it reduces the time to recovery from 15 days to 11. And it also reduces your death rate from 11% to 9 or to 8. That's hardly a re-endorsement for the drug. Oh, and the CEO says we're not making any money off of this. We're giving away everything we make. So, you know, you would think that if a company that cured coronavirus would have a better stock performance. That's the reason. Still, our Mad Hedge Biotech and Healthcare letter has been covering Gilead for years and years, and that's because they had a hepatitis drug, which essentially cures hepatitis, and they were putting themselves out of business curing everyone. So they're on the hunt for new drugs, and this was one of several, and it looked like it has come in. But don't go out and get coronavirus on purpose just so you can call it remdesivir, because it isn't that big of a deal.
A good example of why you go with an index or an ETF rather than a specific stock. If you can put up IBB,
Yeah.
I think you'll notice that that is holding up a little bit better, and that gives you a wider field of companies that could take advantage of discoveries, right?
Yeah, we we saw this whole thing coming in the summer last year. We expected biotech and healthcare, along with big tech, to be one of the two leading sectors for the market for the next 10 years. So we launched the Mad Hedge Biotech and Healthcare letter in September. And since then, it's essentially been straight up. We recommended stocks that were up 100% in 2 months, stocks like CRISPR Therapeutics. So we got the crash and then the immediate recovery to new highs. So you can see the nature of the sell-off. This was an everything for sale at any price, which you only see about every 10 or 20 years. And then you see, well, who's going to lead the recovery? And biotech was one of them, and had this monster gain. So we think biotech keeps running for many more years. We'd be buying every dip. And if you want a model portfolio of biotech names, model portfolio of 20 stocks, just go to madhedgefundtrader.com and you can download it.
Let's turn over to a company that's going to be paying their dividend here pretty soon, and it's in a sector that Buffett still owns, and it's Wells Fargo, WFC. I think their record date is 5/8, which is, I think, later in the week, obviously, and 7.55 or something like that is the dividend yield. It's trading around 27, and it's very close to the 25 low area. Is there value down here, and particularly with that kind of payout, or is this thing going to have trouble?
Yeah, there is value in Wells Fargo. The trouble, there's been value there for 5 years, ever since they get caught in all these scandals. So this thing just never seems to get out of its own way. They always find new ways to get into trouble. So what you use crashes for, like the one we have, is to get the quality at a discount. And in the banking sector, which I'm getting more bullish on, by the way, if you expect inflation, you expect collapsing bond prices and higher interest rates, you want to buy banks. But I wouldn't be buying Wells Fargo. I'd be buying Citibank, Bank of America, and JP Morgan instead. You get a much better return on those. Maybe someday, Wells Fargo will play nice, but I may not live long enough to see that. I'm kind of like in Warren Buffett's boat. He may not outlive this depression.
Do they still have restrictions that, if lifted, could also be beneficial to the stock?
Well, they do, and that's capped the amount of SBA loans which they're able to issue, and that's been a real problem. So those could be lifted at any time, but so far they haven't been, and that puts them at a big disadvantage in the subsidized loan business, which is essentially a free lunch subsidy for all the banks to get through this depression. All these SBA loans, the issuing banks, they get to earn between 1% and 5% in fees on issuing a government guaranteed loan. I mean, it's a free handout, so with zero risk.
The dividends twice what the other banks you mentioned are. Is it possible that they could come out and say we're going to cut the dividend in half, and that would only really put it back in line to where the other banks are?
I think any company paying a dividend right now is mad. They should be conserving cash. The energy industry is a big dividend payer, and they are nuts to be handing out money and borrowing money to pay the dividend. That's a terrible practice. So you're not looking at dividends right now because they can get cut or eliminated. Halliburton, for example, just cut their dividend by 75%. So all dividends are suspect in this environment.
If someone was looking at dividends, do you feel like big pharma might work? Can we put up Pfizer and Merck and get an idea what you think on that?
Yeah, for sure. We like both the stocks. Both are working on corona cures. Yeah, you
And
can see with Pfizer, similar chart to the IBB, the sell everything sell off, and then the monster recovery. So this looks like it has a great long-term outlook with all the drugs they're developing. Oh, and by the way, the main cap on this stock for the last 5 years is regulating drug prices. Do you think they're going to regulate drug prices now? I don't think so. Now everybody wants to throw money at the healthcare industry and the drug industry so they can come up with a corona cure faster. All talk regulation of this industry has completely disappeared. It's gone the route of my tickets to my summer cruise.
what about the sin stocks? Philip Morris, PM?
We don't really follow it that much because it's a sin stock, because it's low value added, and the number of smokers in the United States has been on a 20-year decline, as has the lung cancer rate. So their growth is primarily international, and with the third world or emerging markets about to get hit big time by the coronavirus and having a much higher death rate than ours, I would not be rushing to buy Philip Morris right here.
How about STZ? That's a Constellation brand. You get a play on Canopy in there, I guess, as well.
Yeah, I'm not a big fan of any of the marijuana stocks because, after all, how hard is it to grow a weed? The barriers to entry are minimal. The competition is huge, and they still have a lot of competition from the black market. The people who don't want to pay the 30 or 40% taxes by buying legal marijuana. As far as the main business of Constellation, which is alcohol, they own all kinds of distilleries and wineries. That is a classic cyclical play and probably will recover out the other side of the depression.
How about we take a look at IBM? They're supposedly getting involved in AI quite a bit, and they have a new CEO, and you can get 5% in change while you're watching the movie. But is that movie ever going to turn around much? I mean, it obviously had a great pop. 90 to 130 is nothing to be ashamed of. But is this the beginning of something that'll be a sustained turn, do you think? And if so, getting 5% while you're watching the movie is not terrible.
Yeah, well, this is not an environment where you're looking to make the 5%. You're looking to make like the 50%
Yeah.
or the 100%. And you can do that if you get in the right sectors. Artificial intelligence at IBM makes great TV commercials, but they don't actually make any money on it. And it accounts for less than 1% of their business. Their main business now is services, and they still are behind the leaders in tech on developing new services and products. So, this is another stock that Warren Buffett dumped last year, and who am I to question the wisdom of Warren Buffett? By the way, this is one of the first stocks I ever bought in the 60s. I bought it for $20, sold it for $30, and found a much better way of making money than delivering newspapers off the back of a bicycle in Los Angeles.
Mm-hmm. Now, looking at some of the other, I would say non-mainstream sectors that people don't watch all the time, robotics, a couple of stocks like CGNX, and there's a few others here that I've been following a little bit. If we put up CGNX, because you're looking for what's going on, where the puck's going, right? You don't want to just look at where the puck is.
Kind of on the small end of our coverage range.
Uh-huh.
If we're going to play robotics, we'll do it through the ETF, which is BOT, B-O-T.
I got you. So you get the diversification on a one-stop shop?
Yeah, you're taking a lot of risk with these small companies. companies.
But these guys just went from 40 to 60. It's nothing to shame, no, or
Yeah,
nothing terrible.
from 60 to 40, and I'll take a look at it.
Yeah, and it's trading above its 50 and 200 day. I don't know if it can hold that, but it's been trading above that.
Yeah,
And
now's not the time to go for small companies. You want to go with the big stuff.
Well, this company has a market cap of 9 billion, so it's not chump change, but it's not obviously Apple.
Yeah.
But anyway, it is a sector that people are thinking because robotics can replace the employees, and then basically even some people are talking about you tax the robotic as if he made money or something like that. There's a lot of futuristic things being talked about because the world is changing, and working at home is going to be more popular, and video conferencing, and replacing people with robotic activities. AI. That's the direction the puck's going, it looks like, right?
Yeah, the real demand for robotics is going to be in these meat processors, which
There
is
you
all
go.
done by hand now, and where the fatality rates have just been enormous.
And they can't get the virus, right?
Well, they do. Well, the robots can't. No.
That's what I'm saying. The robots can't. So that's another reason why it actually would increase safety, maybe something like that. How about in this area of precision medicine? There's stocks like NSTG.
Is one of them, and Teladoc is another.
Right, and that's another area that the puck might be going as well. Is there a one-stop shop to do the stocks on precision medicine, or do you just have to pick AGIO and ARKG and places like that?
Yeah, the way this works is they'll wait for the sector to top out, and then they'll bring out the ETF.
That'll be the worst thing that can happen, right?
Market tops once they get too popular. But put up TDOC, TDOC.
Yeah, that had a big run.
You'll see Teladoc, and you can see what I'm talking about. This has been another one of our core recommendations in our biotech letter, and it's absolutely gone nuts. A friend of mine called me a couple of weeks ago, said, should I sell this short at 175? And I said, you're out of your mind. And looks like we went up to 230. So too late to chase now, but it gives you an idea of what's been moving out there and where the future of the technology is going.
Another virus-oriented stock, because obviously this thing got its legs when people couldn't go to the doctor. This next one, obviously Zoom, ZM, that had a big run because everyone's working out of the house using these conferences. But also I was noticing that Google and Microsoft and others are coming up, and Facebook are coming up with their own video conferencing, and that's a lot of competition. Is that going to make that blow-off run-up that we had tough to come back to, or what do you think?
Well, this has been another one of our recommendations with our Mad Hedge technology letter. We got into this thing in the 70s, and obviously it's gone crazy. It's doubled since then. I wouldn't chase it up here. The new competition is an issue, but Zoom itself is also hiring like crazy and adding new features to their software. So probably around here is not a bad place to get involved again.
How about the ride sharing? We go with Uber and Lyft. Can we look at those stocks and get an idea? Obviously, not many people going to the airport, and I think that was what 70% of their business going to the airport or whatever.
Right. Yeah.
So, is this thing got a future? I know they're cutting jobs.
We never ever like this. We told people to stay away from the IPO, which was a disaster. And any business model dependent on people working for $5 an hour, which is how much the drivers net, can't last. The barriers to entry are very low. Turns out Uber did better than anyone else because they were breaking the most laws, in running their business. And how many people want to get in an enclosed space today that's already been occupied by 20 people that day?
What about companies in the tech area that are larger cap and they pay some dividend, like Intel or Cisco? Are you on board with any of that?
Because the epidemic has greatly accelerated the move to a digital world. So Intel and Cisco both do really well in that situation. They're kind of dinosaur companies. That's why they even have dividends. But yeah, I would say the outlook on both of those going forward is good.
And in the semi area, NVIDIA, NVDA, I know you were big on that for a long time. You still on board?
We still are. It's one of our number one sector choices in technology are the chips. There's three of them. There's NVIDIA, Advanced Micro Devices, and Micron Technology. And these just have been huge performers for us. We've had everybody in these things. And guess what? You accelerate the move to a digital world, you create a global shortage of chips. And, there was some concern, when the virus was peaking in China, that the factories in China would get shut down or the demand in China would be shut down because we supply massive amounts of chips to Chinese companies to put in their products to then ship back to us. But that appears to be over now, and it's full speed ahead for all three of these companies.
And AMD gave you a little bit of a break going from the high 50s down to below 50 there for a little bit. Now it's back above 50. 200-day is down there where around 44 or something like that, right?
Yeah, these stocks look like it tried to break out to a new high. And after this current correction that we're in, it'll probably make it to a new high.
How about payment processors that are not, Visa and MasterCard like PayPal?
PayPal and Square, we're really super bullish on these. Guess what? One of the best transmission mechanisms of the virus is paper money.
Yeah. Oh, sure.
Stores will not take paper money anymore, at least here in Nevada, and they will only accept a credit card. So all of these fintech companies, they're going crazy. We were very aggressive on PayPal at work, and we're still recommending it.
How about Square SQ? It's come back a little bit, but it seems a little bit stalled out. But is there a big future there? Because obviously,
yeah, we're very positive on Square also. That was another one of our Armageddon portfolio picks. Stocks to buy at the bottom.
Sure.
That worked out pretty well too.
Qualcomm looks like they're going to do pretty good coming out of this, or that's another one a little bit like Square where it had a run up, a little bit stalled out right now.
So Qualcomm is one of the big 5G plays for fifth generation cell phones, which have already been coming out at Samsung and will be launched by Apple in the fall. They had a major battle with Apple over patent issues on chips, which went on for years. That's over now, and that was the main cap on this share price. So I think the world is going to go nuts over 5G stocks in the fall. This is one of them.
How about in the big data sector, some of the smaller ones like YEXT, AYXX, SPLK? Do you see it?
All of those is they're really one-off niche plays. It's hard to get a large pure play in the big data unless you want to go with somebody like a Google or a Microsoft.
Right.
So, we haven't broken that out as a separate sector yet.
How about this area called Internet of Things, IoT? And there's companies obviously already in there like Intel, Cisco, IBM, Qualcomm, but they also have other ones like ADI, EMR, Rockwell, ROK. Anything?
Yeah, we like the whole sector. Internet of Things will explode tenfold as a spin-off of 5G. 5G increases the bandwidth of all of these things greatly, and is the difference between functionality and non-functionality for a whole range of technologies, and Internet of Things is one of those things. This is where you get into smart houses, smart refrigerators. I happen to have a smart doorbell right now, which is fascinating. Not only am I getting all the FedEx guys as they come to the front door, I get all the animals that walk by at night.
The crypto area. Do you have anything cooking in the crypto area or in cryptography or whatever?
No, it's leave that for the kids.
Yeah.
Volatility is enormous. It's just another fiat currency, even though they claim to be replacing fiat currencies. Nobody really knows why this moves when it moves. I know they're trying to restrict the supply now to get the price to go up, but it's been in a long-term downtrend for a couple of years now, and I don't really see that ending anytime soon. You know, when you can buy an Apple down 40% from its recent peak, why the hell are you even thinking about a cryptocurrency?
Yeah. Yeah. Well, some people like to go into the uncharted territories,
There are always people who want something new. Every year there's a new thing. There's a marijuana or a cryptocurrency or a rare earth. People gravitate towards these things. They always end up getting their head handed to them.
Now let's turn towards something in the commodity sector, gold. Obviously, it's gone up towards that 1800 number, backed off a few times. The gold stocks, GDX, have have gotten above their resistance there, but they're kind of still hanging around. Silver totally has not been able to get on its bike as well, and copper certainly is lagging. Is there a special situation in the actual bullion that's causing some type of a squeeze that's not being correlated to the actual stock? I think we have miners announcing earnings this week, but the thing that's confusing me is the last time we were at these levels, we were at 70 or so on GDX, and now we're trading in the 30s. And I'm wondering if there's a dynamic there where there's really just a squeeze on physical gold, and actually once that squeeze abates, that the price of gold may roll over, and the shares which have just struggled to make a new 52-week high may also do like they did, when gold had a correction and GDX went down to like 20 or 25 or something very quickly.
Well, you've raised a lot of different issues there. I'll get to them one at a time.
Yeah.
First of all, I urge you to go back to the last 27 seminars presented by David Kosmitter, because in every one of those, I was begging people to buy gold.
Right.
We've been bullish on gold from 1,000 all the way up to 1,800. We think it could hit a new all-time high at 1927 in a matter of weeks, if not months. And once we break the old high, then it's a straight run to 3,000. So there are a lot of people buying gold which aren't buying the stocks, and they're not buying silver, and they're not buying copper. Copper is more of an industrial play. That's in the pits right now. Silver is more dependent on solar energy. Every solar panel needs some silver in it, and electric cars also need silver. And solar energy has just collapsed. With gold, you have central bank buying from China, Russia, Iran, and all the other countries that don't want to have anything to do with the US dollar. So you have that, and then you have hedging demand from portfolio managers all over the world who are all buying gold as a hedge. So, and there's another one. For the first time in history, gold has a positive yield relative to other currencies. If you have a negative yield on the euro and you go into gold, which yields 0, you're making money on that, or at least losing less. So first time in history, gold has a positive yield. That's another reason to buy it. I mean, there are a lot more reasons to that. As far as the stocks, the GDX goes, in panics, people sell all stocks. It makes no difference if they're a gold stock or not, they'll take them down. And the same exact thing happened in all previous crashes. The gold stocks got crushed, the physical gold went up. So that's why we urge people to buy the physical gold. A miner is a stock first and a gold play second. You only want to buy the pure gold plays as hedges, because that's the only thing that will perform as a hedge, and that's the GLD ETF or physical bullion or American Eagle coins.
Some people are saying that the amount of contracts on GLD has grown to a point that if people stayed in them and said, deliver me that gold, that there'd be questions on whether they have the gold to deliver. And that might be
Well,
one of the reasons why gold coins are trading at $135 over spot, which anybody who knows anything knows that that's a pretty rich premium.
yeah, that's true for all of the commodities. One of the, they've always had a number of derivatives that far out exceeded the underlying supply. I think it's like 100 to 1 in the case of gold, and it's 100 to 1 in the case of oil. That's why you got to negative prices in oil, and we'll probably see that again with the June expiration, where you have futures contracts, off the book, dark market derivatives. No one knows how much is out there, but when they all wanted to sell the same time, you got to negative prices. So that affects the gold market too, except it's working on the upside in gold instead of the downside in oil.
I've been following the debt market in Oxy Petroleum, and obviously when it was really going crazy there a month or so ago, the yield on some of their debt hit 35%. Now that yield is on the non-callable 9-year instrument. It's been trading as high as 12.5 and as low as around 11.75. They announced their earnings this week. What would motivate you? It's trading 75 cents on the dollar. What would motivate you to think that there could be a reasonable buy there on a non-callable 9-year instrument on Oxy, trading at around 12% yield?
Well,
What would you look in the as far as their coverage, or some way of trying to assess whether they actually could pay?
Well, I worked in the oil industry for many years, and there are always a lot of accounting fictions going on all the time. If you're paying a 12% yield, it's for a reason, and that reason is that the fields underlying the bonds as collateral have not been marked to market.
Right.
I guarantee you that most of the producing fields out there are being carried on investors' books at $50, $60, $70 a barrel. Okay, they don't mark those fields to market. Occasionally do it on an annual basis or in a liquidation. So you have a bonds paying 12%, but keep in mind that the collateral supporting those bonds is not there.
Mm-hmm.
That if you had to sell that collateral, you might get 5 cents on the dollar. That's true for the entire energy sector and always has been. So given all the other fantastic long-term growth opportunities that have been created by the virus, the epidemic in technology and healthcare, the last thing in the world you want to do is try and call the bottom in oil.
Right. As was saying, when you're buying into oil, you are making a bet on oil prices. But, when you are a senior debt, you're in a different position than the common. So, obviously I wouldn't compare the both of them at all.
Right. But, this is a much more of a specialist type investor. Requires a lot more research. You have to have a good team of lawyers.
Right.
Who can represent you in a bankruptcy proceeding.
Right.
Not for your average ma and pa investor. Hedge funds do well in this sort of things. And there are specialist hedge funds that'll do exactly the kind of trade that you were talking about. We recommended Tesla convertible bonds last June when the stock was at 180 and the bonds went up 150%. The junk bonds were yielding about 8% then. We recommended them. Bonds went up 150% after that.
The gold obviously has a nice trend to it, but I was noticing that the 3-year moving average is down at 1365 and the 2-year moving average is 1399. So if we did not take out the 1800 right away, do you think there could be a potential under some circumstances to have a correction that would surprise people but not violate the trend this summer?
Getting surprise recovery in the economy.
Mm-hmm.
And right now, all surprises in the economy are going to be to the downside.
I got you.
I think it's going to take a lot longer for this economy to recover. Even if you opened up every state and every business, getting people out of their houses without fear of contracting a fatal virus is going to keep this economy slow for a really long time. I don't plan on taking any airplane flights for the rest of the year. How about you?
I wanted to actually go to France and play a little golf down at Côte d'Azur. So since I've been cooped up like this, I'm getting cabin fever. So I may throw a mask on and roll some dice on that.
Well, pitch a tent in your backyard. That's what I did. It's a lot safer.
Anything you're looking at now that I haven't touched? We certainly went around the world in 20 days here. With regards to any other stocks that you just wanted to throw out there, or maybe give a little bit more insight on on what people can get when they hook up with you?
Scaling into all the technology leaps that we could find, which we're still trading. Right now, I'm telling people to do nothing,
Right.
Or run a small short, and to sell short the bond market on any 2-point rally if we can get one. The smart trade here is selling short bonds and betting that, a increase in the national debt of 50% in a year is going to be really damaging to the bond market over the long term. Other than that, it's really boiled down to a 2-sector world, tech and biotech. Any substantial dip, like 25% in single stocks, you want to be piling into those in any kind of long vehicle that you can come up with.
Okay. One thing I've been looking at on the S&P, these moving averages, and the 3-year was coming in around 27.75, and the 1-year was up at 29.75. And in 01 and 08, they crossed over to the downside, and it did take years for the market to recover. Whereas in 2016 and 2018, we were only under these things for a month, just like we were just under there a month, and then they popped them back above, and then we got back on our merry way. Do you think if we can keep this market above 27.75 and it can start reading out at 29.50 or better, then maybe the worst is behind us? But that right now, you think the odds is not that great for that?
A large number of companies, including a lot of big ones, aren't going to survive this pandemic, and we'll come out of this with a smaller but much more efficient economy. So it's more important ever to be in the right stocks, in the right sectors, and avoid the wrong ones, because the punishment for being in the wrong sector will be worse going forward. The rewards for being in the right one will be better. It'll be the ultimate stock picker's market.
Right. Yeah, that chart that I have on the screen now gives you a little bit of an idea of what I've been looking at. In 01, we crossed over, everything crossed over, and it took to like 04 or so to get going again. And then in 08, it rolled over in 08, and then it really took till about 2011 to get back going again. So right now we've penetrated it on March, and then we got back above it in April. And now it's being tested down here because the average today, I think, is something like 27.85 or something. So if we start tanking again and these averages cross over, then I think that longer term thing that you were talking about makes a lot of sense. If they keep it above the 27.75 with all the shenanigans, for all we know, this thing could get back going again. And that's why you have to be a little bit flexible. You get too negative, and then the next thing the thing's going the other way, because, sometimes this market tries to go the way to hurt the most people,
Yeah, all of your previous corrections, no one was afraid of dying.
Oh yeah, that's the thing. They're not of the same. They're not of the same cause. I hear what you're saying there. Yeah.
And the only thing that can end this depression and restore consumer confidence is a working vaccine, and that's probably years off.
Or the Fed gives everybody $150,000.
You can't win it if you're dead.
Yeah, that's true. That's true. But I mean, it just seems like they're not using helicopter money. They're using B-52 money now.
Well, and the savings rate has gone absolutely through the roof. It was 1% before the epidemic. It's now up to 18%, which is a 50-year high. Americans never save. Yeah. They always blow all their money. And for the first time in 50 years, they're saving.
Because they've come to the conclusion that the future earnings that they could get are very much up in the air.
Well, there's no way to spend it. All the stores are closed.
Oh, that's true too. Yeah, a combination of you can't spend it, plus your confidence level can't be on an all-time high when it says, State of New York unemployment office on your check rather than, wherever you used to work.
Yeah, so you really need a vaccine.
Yeah.
That's the only way to end this. If people need confidence to go out, without dying of a horrible death.
And
So,
you have to make sure the vaccine's not done at lightning speed so that the side effects are only found out after the fact, right?
yeah.
Yeah. Well, we're at the top of the hour, John. I know you have some stuff you'd like to offer the people listening, so why don't you do that? And again, let them know how they can get a hold of you.
Yeah, if you want to get our free entry-level research every day of the year, you can sign up for my Mad Hedge Hot Tips by going to madhedgefundtrader.com. There you just have to enter your email address and you'll get hot tips every morning, first thing in your mailbox. And it's been a very popular product. If you want to learn out more about us, just go to our website at madhedgefundtrader.com. That's me in my better days, wearing my favorite London hat. And I don't even wear glasses anymore. I've been working out so much. So yeah, that's it. madhedgefundtrader.com. And you can find our 11-year track record by scrolling to the bottom of the page. Can you do that? There it is. There's our performance versus the S&P 500. Right now, we're beating the S&P 500 about 3-1 on a 10-year view.
All right. Yeah.
Daily audited performance, we're issuing about 200 trade alerts a year. This year will be closer to 300.
Okay, so everybody can take advantage of that by getting a hold of you through the website. And thank you very much, John, for being here today. I'm with the Option Professor, and each week I do have a weekly update where I go over all the things that I'm working on. And so to get online for that one, just simply email optionprofessor@gmail.com, and you'll get in the queue, and we'll get the weekly update out to you. Again, thanks, John, for being here, and I'm going to turn it back over to David now.
Take care.
Okay, thanks guys. Lots of good information today. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast network. You can also go to TimingResearch.com to get access to the recording of this show as soon as I can get it posted, or any of the past shows. If you want to see what John was talking about for his previous presentations, you can just go to TimingResearch.com, and there's a search bar on the side of the website. You just type in his name or any other guest name, and you can get access to any of the previous episodes and presentations that they've been on. Also, I just want a quick reminder to mark your calendars for this big event that we have coming up in a few weeks. May 19th, 20th, and 21st. We're going to have 30 different presentations throughout the 3 days. So John will actually be giving one of the presentations on the stock and options day, and Jim will be giving one as well. But we have 3 full days of stock and options presentations, Forex day, and a futures day. So be sure to mark your calendars for that. And yeah, just want to thank my guests again for today. John Thomas of madhedgefundtrader.com, and Jim, the Option Professor at optionprofessor.com. Thanks, everyone.
Thanks, David.